Welcome to another edition of Around the Table with Stacy Smith as we take a look at the economy and investing. Too many times over the past year, I have talked about how much the markets have declined. That was not the case, though, for the month of October, especially for the Dow Jones Industrial Average. With one trading day to go in the month, the Dow was up more than 4,100 points, or a gain of more than 14%. The Nasdaq was up nearly 5%. The S&P 500 put up a gain of nearly 9%. But, and there always seems to be some sort of a caution, the Fed meets this week and nearly everyone is anticipating and betting that the Fed will raise rates by another 0.75%. So it begs the question, is the October surge in the markets just a bear market rally, or has Wall Street factored in the higher interest rates and the probability of lower earnings? That's something we're going to discuss today, and no one knows the answer, but that does not stop us from talking about it and how another rate hike and the rates could affect the rest of the economy. So here to talk about all of this is my panel of financial experts and advisors. As we go around the table, we find a name familiar to a lot of people in Pittsburgh. That is Bob Fragasso. Bob has been in the investment and advisory business for nearly 50 years and is chairman and chief executive officer of Fragasso Financial Advisors. Across the table, we find Carrie Coghill. Carrie is also the president and CEO of Coghill Investment Strategies, which is headquartered here in Pittsburgh. She is recognized as one of the nation's leading voices on financial advising. Also with a seat at the table is Frank Brissetti. Frank has been in the advising business of clients for 50 years, and Frank helped to establish Harvest Financial, where he also happens to be the executive chairman. Now, one of our regular panelists could not be with us today, Kim Forrest. We hope that Kim will be joining us again on our next edition of Around the Table with Stacy Smith. Now, as I mentioned, the market surged ahead in October with the knowledge that the Fed is probably going to raise rates again this week. So, Frank, have the markets already factored in another rate hike now and also down the road?
Well, also down the road, I think they're factoring in the Fed being a little less aggressive, which somewhat explains the activity we saw in the markets last week. They certainly have factored in what's going to happen this week and probably what's expected to happen in December, which is another 0.5 point hike. It's what comes after that is being gambled on, if you will. Market rallied because their expectations there'll be less. The interesting facts that I've seen out there is people still have tremendous buying power. Their savings accounts and bank accounts are still about $1.7 trillion, which is still incredibly high. So the purchasing power has been very good. It's also reflecting in corporate earnings. Corporate earnings, with the exception of some tech industries, and not even so bad there, they're just being repriced because of the rise of interest rates. We're seeing earnings be a little better than expected, not a lot better, but a little better than expected, which is also driving this market a little bit. Right now, we have a very interesting dynamics going on, and it'll be interesting to see how it plays out going forward. But as far as the belief that the Fed is going to get a little less aggressive, I personally think that's probably a pretty optimistic point of view.
I think it's really interesting how we look at interest rates now. And, you know, the three of us go back a long time. And now that we have, you know, people like us on TV talking, and I always say, you know, pay attention to us, but no one else. We have become obsessed with interest rates. And, you know, interest rates going up to curb inflation is one thing, but we also have to keep in mind when they stop raising rates, and should they get to a point where rates are coming down, what's the reason for that? And, you know, the big concern is with rates going up as much as they have, that and the economy, if the economy starts to slow, which we actually haven't seen, will that cause a recession? So there are more factors here in terms of what the market will do than interest rates. And I think that the minute we get the idea that the Fed's going to stop raising rates, like, you know, the market will probably rally for a minute until we step back and say, whoa, wait a second, why have they stopped raising rates? Is it because earnings are starting to slow? I have some serious concerns about earnings going into next year, because one of the reasons and one of the things that the Fed is looking at is the employment cost index and how much are wages going up. That's a really big issue that's factoring into this. And it's one of the elements of inflation that remains really strong.
One brief add-on to that. And you both mentioned it. Big driver right now, in addition to the interest rate considerations, it would be reporting of corporate earnings. And they are predominantly beating expectations right now, which would seem to indicate that corporations have been able to handle pricing and costs with the inflation we've had thus far, and therefore able to show positive earnings and earnings growth. Will that continue? Right now, most segments of the economy are doing well. The exception is the residential housing, which is the first indication that interest rates are slowing the economy, which is what the Fed wants to do. Once the Fed sees more of that kind of slowing, it can take its foot off the pedal, not necessarily reverse rates, but stop raising them to the degree they are right now. And that'll be good. And that's when we'll get the beginnings of a good rally. Not a breakaway rally, but the beginnings.
I want to bring up something that Frank said in juxtaposition with what you're saying and also what Carrie is saying. And that is, Frank, you mentioned that there's some sort of 1.5 or whatever it was trillion dollars in savings out there. And how does the Fed have to factor that in the fact that, that money can still be spent and continue to drive up prices?
I think that's why I believe they're going to remain. One of the reasons they're going to remain aggressive for at least another couple months past December. And what we have is people are spending money. I drive on the highways. There's cars everywhere. We have high price of gas, but nobody seems to have parked their car. I try to get into a restaurant, and at lunchtime in downtown Pittsburgh, you've got to make a reservation. That's unheard of. Did you ever see that before, Bob and Carrie? I mean, it's unprecedented what's happening in my mind. All right, in my knowledge of history, we do not have enough employees. People are working; they're making more money, and they are spending it. This is called a good economy. It's also inflationary because the cost of wages has gone up. We have more demand than we have capacity to create. We've got some supply chain issues out there, partly due to COVID. I just saw this morning that there's an Apple plant in China that's pretty much shut down because of COVID again. That means there'll be a shortage of iPhones. And we're trying to shut down China. There's so many dynamics going on. We're trying to bring back on shore the manufacturing capacity that the last 40 years we've allowed to drift elsewhere. This is going to create jobs building these factories. All right. We've got an infrastructure bill that's going to create jobs fixing bridges. There's so many good things happening out there that I really find it hard to believe that interest rates are going to slow it down. We need people, or we need technology to replace the people we don't have, which is also something that'll be, I'm sure.
I'll add very briefly, parenthetically. I know you need to move on, Stacy, but that $1.5 trillion that you talked about, Frank, is not only hanging over the consumer expenditure segment of the economy, it's hanging over the investment markets.
Right.
So that's poised to come into some portion of it back into the investment. We have clients that have been building cash, not necessarily going to cash, because we don't time markets, but building cash and not committing it, waiting for more of an assured bottom. And at that point, that money's going to come into the markets, and that'll be good. That'll propel a good recovery over time. And I agree with Frank about onshoring. That's already started in a big way. It's going to be good.
I want to continue this part of our discussion in just a moment when Around the Table with Stacy Smith continues.